Chapter 13, Statement of Cash Flows. So learning objectives. Describe the cash flow activities reported on the Statement of Cash Flows. Prepare the cash flows from operating activities section of the Statement of Cash Flows using Indirect Method. Prepare the cash flows from investing activities section of the Statement of Cash Flows. Prepare the cash flows from financing activities section of the Statement of Cash Flows. Prepare a statement of cash flows. Describe and illustrate the use of free cash flows in evaluating a company's cash flow. And then the sub-objectives are right there with the spreadsheet and the direct method. So reporting cash flows, the statement of cash flows reports a company's cash inflows and outflows for a period. The statement of cash flows provides useful information about a company's ability to do the following: generate cash from operations, maintain and expand its operating capacity, meet its financial obligations, and pay dividends. The statement of cash flows is used by managers in evaluating past operations and in planning future investing and financing activities. It is also used by external users such as investors and creditors to assess a company's profit potential and ability to pay its debt and pay dividends. The statement of cash flows reports three types of cash flow activities as follows. Cash flows from operating activities are the cash flows from transactions that affect the net income of the company. Example, purchase and sale of merchandise by a retailer. Cash flows from investing activities are cash flows from transactions that affect investments in the non-current assets of the company. Example, purchase and sale of fixed assets such as equipment and buildings. Cash flows from financing activities are the cash flows from transactions that affect the debt and equity of the company. Example, issuing or retiring equity and debt securities. So the cash flows are reported on the statement of cash flows as follows: cash flows from operating, cash flows from investing and financing, changing cash, cash at the beginning of the period, and then cash at the end of the period. So in that order. The ending cash on the statement of cash flows equals the cash reported on the company's balance sheet at the end of the year. A source of cash causes the cash flow to increase and is called cash inflow. The use of cash causes cash flow to decrease and is called cash outflow. So here's an example, a little graphic, sources and uses of cash. So go through and take a look at that. Over on the left, you see the cash inflows, and on the right, you'll see the cash outflows. And those are the three areas that we'll use cash for. Cash flows from operating activities. Cash flows from operating activities report the cash inflows and outflows from a company's day-to-day operations. Companies may select one of the following two alternative methods for reporting cash flows from operating activities on the statement of cash flows: the direct method or indirect method. Both methods result in the same amount of cash flow from operating activities. They differ in the way they report cash flows from operating activities. So cash flows from, here's a direct method: customers, merchandise, operating expense, interest, income tax, net cash flow from operating activities. The primary operating cash inflow is cash received from customers. The primary operating cash flows are cash payments for merchandise, operating expenses, interest, and income tax payments. The cash received from operating activities less the cash payments for operating activities is the net cash flow from operating activities. The primary advantage of the direct method is that it directly reports cash receipts and cash payments on the statement of cash flows. Its primary disadvantage is that these data may not be readily available in the accounting records. Thus, the direct method is normally more costly to prepare and, as a result, is used infrequently in practice. Here's the indirect method: net income adjustments to reconcile net income to net cash flows from activities, net cash flow from operating activities. So take a look at that. That's kind of the setup. The adjustment to reconcile net income to net cash flow from operating activities include such items as depreciation and gains or losses on fixed asset, change in current operating assets, and liabilities such as accounts receivable or accounts payable are also added or deducted depending on their effect on cash flows. A primary advantage of the indirect method is that it reconciles the difference between net income and net cash flows from operations. Because the data are readily available, the indirect method is less costly to prepare than the direct method. As a result, indirect method of reporting cash flows from operations is most commonly used in practice. So direct methods on the left, indirect methods on the right, they come out the same way, but then you're kind of, there's a little bit more accountability over on the right than on the left. Okay, so this is comparing them side by side. Sorry if this is video is shaky. I'm on travel, so I had to use I'm holding the camera by myself. Cash flows from investing activities. Cash flows from investing activities show the cash inflows and outlays related to changes in a company's long-term assets. Cash flows from investing activities are reported on the statement of cash flows as follows. So investing activities right there, and then cash from investing activities outgoing. So then at the bottom we have net. So the cash inflows from investing activities normally arises from selling fixed assets, investments, and intangible assets. Cash outflows normally include payments to purchase fixed assets, investments, and intangible assets. So here's financing activities. Cash flows from financing activities show the cash inflows and outflows is for government, related to changes in a company's long-term liabilities and stockholders' equity. Cash flows from financing activities are reported on the statement of cash flows as follows. So there's inflow, and then there's cash used, and then net cash flow from financing activities on the bottom right here. Cash inflows from financing activities normally arise from issuing long-term debt or equity securities. Example, using bonds, notes payable, preferred stock, and common stock creates cash inflows from financing activities. Cash outflows from financing activities normally include paying cash dividends, repaying long-term debt, and acquiring treasury stock. A company may enter into transactions involving investing and financing activities that do not directly affect cash. For example, a company may issue common stock to retire long-term debt. Because such transactions indirectly affect cash flows, they are reported in a separate section that usually appears at the bottom of the statement of cash flows. So here's the example of this company order of reporting statement of cash flows. So take a look at that. This is in your book as well. Okay, so cash flows per share is computed as follows. Cash flows from operations divided by number of common shares outstanding. So cash flow per share should not be reported on a company's financial statement for the following reasons. Users may misinterpret cash flow per share as the per share amount available for dividends. Users may misinterpret cash flows per share as equivalent or better than earnings per share. So here's a checkup. So we're going to issue some common stock, or we're going to purchase new equipment. So we're going to sell merchandise, we're going to pay employee wages, and pay dividends. So let's take a look at this. So here's the activities. First one is going to be investing. Second one, financing, investing, operating, and then financing. So we're asked to classify those activities. Okay, so the indirect method of reporting cash flows from operating activities uses the logic that a change in any balance sheet account, including cash, can be analyzed in terms of changes in other balance sheet accounts. So assets equals liabilities plus stockholders' equity. And then on the middle one, it says cash plus non-cash assets equals liabilities plus stockholders' equity. The bottom, cash right there, cash equals liabilities plus stockholders' equity minus non-cash assets. Therefore, any changes in the cash account can be determined by analyzing changes in the liability, stockholders' equity, and non-cash assets as follows. Change in cash equals change in liabilities plus change in stockholders' equity minus change in non-cash, which is stated right here on the bottom. So take a look at that. Under the indirect method, there is no order in which the balance sheet accounts must be analyzed. However, because net income or net loss is a component of any change in retained earnings, the first account normally analyzed is retained earnings. So income statement and comparative balance sheet, okay? So there's this is what it looks like, and then here's the comparative balance sheet. So notice the comparative means is you're comparing it from one year to the next, and then you're looking at increases and decreases over on the right. Net income, so the net income for Rundell is $108,000. Since net income is close to retained earnings, net income also helps explain the change in retained earnings during the year. So here's retained earnings account, balance is 202, so debit 14, credit 108, dividend declared 14,000. Okay, so our balance would be 282,300. Okay, and this is explained right here. Adjustments to net income. The net income of 108,000 does not equal the cash flows from operating activities for the period. This is because net income is determined by using the accrual method of accounting. Under the accrual method of accounting, revenues and expenses are recorded at different times from when cash is received or paid. Thus, under the indirect method, adjustments to net income must be made to determine cash flows from operating activities. Adjustments to net income using the indirect method. So take a look at this. There's no numbers here, but it just kind of lets you know what's going on here. So step 1, you're doing your depreciation, amortization. Step 2 is looking at your disposal of assets. And step 3 is looking at your changes in operating assets and current operating assets right here, or decreases in liabilities. So here's an example: subtract and then add these, okay? Adjustments to net income is normally adjusted to cash flows from operating activities using the following steps. 1, expenses that do not affect cash are added. Such expenses decrease net income but do not involve cash payments and thus are added to net income. 2, losses on the disposal of assets are added and gains on the disposal of assets are deducted. Step 3, changes in current operating assets and liabilities are added or deducted as follows. Increase in non-cash current operating assets are deducted. Decrease in non-cash current operating assets are added. Increase in current operating liabilities are added, and decrease in current operating liabilities are deducted. I know that's a lot, but you'll see here in a bit. So here's what this means. Step 1, step 2, step 3. So this is kind of the order that would follow, okay? So I know it's a lot of words, but graphically it's easier for me to understand it. So maybe that'll help you. If you like words, follow these steps right here, okay? But I like to see it graphically, or actually set up so then I can see it, pluses and minuses. The next few slides will show how Rundell's net income of 108 is converted to cash flows from operating activities of 100,500. So here we go. So add depreciation of 7,000. So we had a credit balance, then we credit another 7,000 depreciation for a year. So it takes us up to 65,300. So that was step 1. Step 2, deduct the gain on sale of land. Okay. Deduct on sale of land. Step 3, add and deduct changes in current operating assets and liabilities, including cash. Okay, accounts receivable, net, the 9,000 increase is deducted from net income. Okay, so here's our account receivable, 9,000, deduct 8,000, deduct 32,000. So these are what's going on in here. So accrued expense payable of 2,200, and then income tax payable deducted. So if there's not parentheses, it's decreased. If there's not, it's increased. Okay, inventories 8,000. Okay, we already talked about right there. So 8,000 is deducted. Then 3,200 is also deducted, and then 2,200 is also increased. So it's just going through each step of what I had already talked about right there. And then 500 decrease in taxes payable. Okay, so whenever we look at this, our account receivable will be 5,000, and then our account payable will be deducted for 2,000. Okay, so when all this happens, this is kind of what this will look like laid out. So 120,000 net income, depreciation expense, loss on disposal, and then changes in current operating assets. Deduct 5,000 for account receivable and deduct account payable for 2,000. So our balance will be 120,000 after that period. Okay, so cash flow from investing activities, Rundell Incorporated. So cash flows from investing activities reports the cash inflows and outflows related to changes in a company's long-term assets. So the comparative balance sheet lists land, building, and accumulated depreciation building as long-term assets. Similar to preparing the cash flow from operating activities section, each change in long-term assets account is realized for its effect on cash flows from investing activities. So here we go. 45,000 decline in land of Rundell & Corp was from two transactions as follows. So here's what it looks like. Balance, so sold for 72,000. Credit, we're going to get 60,000. Takes us to 65,000. Purchased for 15,000. So it takes us to 80,000. Okay, so here's land again. Cash received, and then the paid. This is just an explanation of what we just talked about. And then here's the building. Okay, so 20,000. So we purchased for cash, so it takes our balance to 260,000. It was, our depreciation was 58,000. So we deducted 7,000 or credited 7,000. So our balance is now going to be 65,300. So then here's the cash flows from investing activities. Cash paid for purchase of building will be decreased by 60,000. Okay, so here's what this will look like when it's laid out. There was an increase when you compare them. There was an increase. There was a decrease right here in equipment, and then our depreciation was an increase. Okay. So here's a checkup corner. Just to take a look at that, if we did that correctly, and there were no disposal of equipment, and all purchases of equipment were for cash. Prepare the cash flows from investing activities section of the statement of cash flows. So that's what it would look like. So here's financing activities. Reports the cash inflows and outflows related to changes in a company's long-term liability to stockholders' equity. Comparative balance sheet reports changes in bond payable, common stock, and paid in capital in excess of par, which in excess of par we looked at in the previous chapter. In addition, dividends payable has changed, which impacts retained earnings. Each change must be analyzed to determine its effect on cash flows from financing activities. So here's the bonds payable. Balance is 150,000. Retired by payment of cash at face. So debit 50,000. So we're going to have a credit balance of 100,000. So this is just going through that debit right there. And then here's our paid in capital in excess of par and common stock. Okay, so there's 16,000 right here, and then credited for 8. So then our balance is 24,000. Now our common stock right here was 80,000, and then we credited because we issued 4,000 more shares, so we get more capital. So our balance will be 120,000 now. Common stock, and then cash received from sale of common stock was 48,000. So 4,000 times 12 will give us 48,000. Okay, dividends payable. Okay, here's what it will look like. Balance is 10,000. Debit 10,000. So we have a zero balance. When we dividends declared to 14,000, so we have 14,000 balance. The cash paid 14,000, so then we have nothing. Then dividends declared to 14,000, so our balance will be credited of 14,000. Okay, so cash dividends paid during the year can also be computed by adjusting the dividends declared during the year for the changes in the dividend payable account as follows. Sales over here, plus decreases in account receivable, minus accounts receivable, increases in account receivable, and then cash received from customers. Okay, so then sales, 1,180,000 minus 9,000, which is an increase in account receivable. So then our cash received from customers, $1,171,000. Okay, dividends paid by Rundell, 28,000, because there was two of them, remember, so 28,000, increase in dividend payable, 4,000. So cash dividends paid will be $24,000. And then cash paid for dividends is $24,000, which was right there. Okay, I'm going to go ahead and stop right there, and then I'll finish the second half of this video here in a bit.